Hello, anybody out there? Is there anybody out there? In case there is somebody out there watching, this is your 4 indexes. I'll be checking in periodically. I'm off the desk right now. I'm going to take my lovely wife to the bagel shop for a little bit of bagel action. There's absolutely no reason for me to sit here and watch the market open. It means nothing to me. All right. I'll see you guys in a bit. I'll be checking in. Hope you have a great morning. on the desk for just a minute. Nothing's really going on right now. I just had to peek. I'll see you guys in a bit. And yes, BCE looks good. It's got a good yield. If it can close up in that green box over here, fits, you know, I might have to find a way to get that into the invest portfolio. Hey, just checking in, guys. I'm gonna go grab a bite to eat. Be back at the desk somewhere after 1 o'clock, and we'll get the day started. I've been having a lovely morning with Rebecca. Nothing, I can see nothing's changed here. A little weakness right into the last, what is it? 3, 6, 9, 12, 15 minutes back to the VWAP. So the market's not really doing anything. And honestly, this is what I'd rather see on Fed day. I like to see it weak before the news. I don't like to see it rally before the news. So that's not a bad thing. I came back. I left you with this thought here. Maybe I own a little bit, right in here. And I'll say the same thing about Uber. Those are the top 2 names on my list, and Uber is coming out right now. So anybody, monitoring this situation, there it is. So those are 2 names that are at the very top of my whiteboard, and I'm monitoring closely. But other than that, continue to believe that I just don't want my mind clouded by anything other than the action that occurs at 2 o'clock and 2:30. And so I'm going to remain off the desk until, like I said, somewhere between 1 and 1:30, I'll be back on the desk, and we can kind of get the feel of what's happening, and we'll post the link and all that kind of stuff, and we'll chat, and we'll be ready by 2 o'clock together. All right. So want to enjoy lunch. A little taster is Uber as it breaks out, and I'll see you guys in a few, I don't know, somewhere around an hour, maybe less than an hour. All right. On the desk after a very refreshing morning. Looking forward to whatever the market wants to send our way. Looks like so far market's traded in a relatively tight range all morning, and we're at the top of that range heading into the comments. It's 1:06. The circus doesn't start until noon. The clowns come out at noon, and then the three-ring circus starts at 2:30, where Chairman Powell puts his head into the mouth of the lion. What have I missed? I'm coming to read some of your things. What do we got cooking here? I'm reading, trying to catch up. Oh, here comes Uber up a little bit. I spoke to you about that the last time I popped on. We are on core sciences, all of us, maybe, keep it on the down low. I shared that thought this morning. Ares was out there buying it in the pre-market as the insiders are buying. That looks really good. And what you wanted to just do is scrunch that down. That's a cup handle breakout. GEHC, is that coming on? Oh yeah, look at GEHC. Jesus, you've got to be kidding me. Cops find explosives in car near Trump rally on Long Island after second assassination attempt. Oh my goodness. Now the story's fake. Now the story is fake. I don't know. I don't know what to make all that. GEHC is running. Dad's talking about Kratos. Kratos certainly looks good. First stage base trying to come out. IAUX. I am gold. All right. SKE. Boy, were you right on that one. What a home run. Oh, Lena, thank you for that. Got the link for us. Eaton's working. Nice to know Ares is going to be at the circus with me. He's got his bunch of popcorn there. I love it. Reading up on this ETN thing. Hey, Lena's going to join us for the circus. Should be fun. This eating looks like an interesting idea, Harris. Hmm. Slow and steady growth there. Nothing wrong with that idea in the portfolio. See Stephen's joining us for the circus. Excellent. Come one and all. Brian, all right. Knew I could count on you. Stephen, what's happening? I think 25 basis points, but you know, market thinks 50. It's moving higher into the close, into the action here. All right. Welcome to the show, one and all. The circus starts in half an hour. Find your seats, grab whatever drink, popcorns you want. The market is making new highs as we speak for the trading day. As always, remember, look, no matter what I talk about here, at the end of the day, you got to make your own choices, risk tolerance, goals, strategy, execute them, be the smart money. You're going to have to do that. Here's what I'm going to do. The clowns start coming out of the car at 2 o'clock. We'll talk about what the news is, what the reaction is, what I think's going on. Powell sticks his head into the lion's mouth at 2:30, and the real action starts. Those of you who know me know I don't trade anything until 2:30. I want to hear what he has to say. So generally, there's that piece of news that hits at 2 o'clock, hysteria, and honestly, the market almost always ends the day the opposite of what the hysteria is. So news hits the tape, market down big, it ends up. News hits the tape, market goes up big. You know what I'm saying? So, all bets are off. The 2 o'clock reaction really means nothing. It's when he starts speaking and how does he map it out. So, I think that the expectation is, in my opinion, 25 basis points. As I said earlier, I think that, Powell, if we watch the way he's behaved all the way through this, his spirit animal is a tortoise. I'll be shocked if he runs out there and does something more than 25 basis points. But the market thinks 50 right now. I think last time I looked in the betting parlors, it was 62% think that there's going to be a 50 basis point cut. Some people are out there thinking 75 basis points. I mean, they're out of their minds. I would be shocked. I wouldn't even know how to interpret 75 basis points. I mean, you'd think the market would go up a lot on that, but I would almost say, I don't know, the market would be freaked out by that. The Fed's always behind the curve. If they were to jump 75 basis points, I don't know. That would be almost sending a message that they're wildly behind the curve, So I don't know, maybe 50 basis points is just where we need to be. And, but personally, I think it's going to be 25. I'm just spitballing with you now, and this is something really important that I want to share with you. If you are ever making an investment decision based on guessing what the Fed's going to do, what the non-farm payroll number is going to be, what an earnings announcement might be, you've already lost the game when it comes to investing. You can't possibly, over a long period of time, succeed that way. Guessing's not what investing is all about. Worst thing that can happen to you is you guess right a couple times, right? Because then the third time you put everything in because you're great. You're guessing everything right. Then you get your head handed to you. You got to come up with a strategy, execute that strategy, and live with the results. Tweak the strategy as you go every 3 to 6 months. Maybe do a big review after 12 months, right? What I like to do here, I day trade, swing trade, and I invest. I lean into the discipline that's making me the most amount of money in that cycle. Right now, it's our invest strategy. So I'm leaning into that, right? I'm building a special situations fund where I'm going to be using the tools that we use, some of the tools that we use in our invest portfolio, okay? As an example. But if you hang your hat on one particular piece of news or one day or guess Fed might do this, so I'm going to do that, you've already lost the battle. Number one, you don't know what the Fed's going to do. So you're just literally gambling. You may as well go gamble. Go have fun in the casino. Putting money to work because you think the Fed might do X is gambling. That's got nothing to do with investing. And on top of that, you haven't the slightest idea what the reaction to that news is going to be. You know, be honest. How many times you say, oh, the Fed's going to do that. I'm going to take this position. The Fed does what you think. Then the market goes and does the exact opposite. And you're like, what the heck? It's because it doesn't make a difference what the Fed does. It matters what institutions do. Institutions move markets, not you and me. It's the big money that moves markets. So our job is to react to what institutions are doing. We use ARMR algos, risk monitors to put us on the right side of probabilities when reward's worth risk, knowing that sometimes we're going to lose some money. It's just a probability matrix. I don't know if this is going to be the time. It could be. Put money to work last week. Fed meeting, who knows what he's going to do? Could be 25 basis points, and everyone interprets that as that's terrible. He's behind the curve and blah, 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 and the market goes down big. I don't know. We'll react to that. End of day, end of week are the stops that we're using. I come into today somewhere around 20 to 30% cash and equivalents. Gold, treasury bonds, treasury bills, physical, somewhere in that vicinity. Okay? And then we just adjust the portfolio as we go. So those are my thoughts for you right now. I think 25 basis points. I think it's possible. I think Aris mentioned this. I think you're probably right, Aris. 25 basis points, which I think is what he's going to do, is probably bullish for big cap tech, bearish for small cap. But that's just a guess. I'm just sharing with you goalposts. Then we have to see what the real reaction is. I don't know. Why would that be like that? Because if he's behind the curve, if the Fed goes slow and the market thinks he's behind the curve, then the smaller, weaker companies theoretically will have trouble and money will rally around the big names. That's just a theory. I don't know if it happens. We'll go, oh, okay, that's what's expressing itself today. You know. So we'll just have to wait and see. I don't like to spend too much time guessing because it doesn't make a difference what I think. It's only what the reaction is. All right. So we'll get this thing going live in a little bit here. Thank you, Lena, for putting that up into the room. So I can just click on that link. Anybody in the Slack room, there's the link if you want to listen to it and watch it on your own. This looks like an old link, Lena. That looks like an old link. See if we can find a link. What am I doing? Clicking on what? Oh, Federal Reserve live link. Oh, I see. September 18th. Thanks for that. Thank you.
Financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve and click on About the Fed.
I don't. All right. We're just watching the backing and the filling that's going on. See, it ran right up this white line in here, I think is a new high on the year, right? Yeah, that goes back to those highs. So you're looking at, again at the, we're looking at a 3-minute bar chart here, right? Let's squinch it up a little bit. Anybody, the Armor Report subscriber who may be joining us for this? These are 3-minute bar charts. Whoops. That white line is the new high on the year. So we tried to go above it and then got whacked back down. Just waiting for the news. Well, that's a great link right there. Data center value chain. That's so cool, Harris. Thanks for that. Uber's making new highs in here, so we put on a little bit of Uber if you wanted to trade something early today. Had a little bit of that Uber. Put that on in here. It's up to the ATR high of the day now. So again, we're looking at a bar 3-minute chart here. So inside, these are the charts we use to day trade. This is the daily chart. If Uber can close in the green box, above the green box, I'm going to be long Uber for more than a day trade. We've traded it a couple of times the last couple of days, but I'm waiting to really capture it here as it broke above the opening range high. So pretty much we talked about it right here. So that was where we wanted to capture it. Now it's up on the day. Now it's in the green box. If it closes up here, I'll stay with that. That'll end up being a position in the portfolio. The other is CORZ, Core Scientific. I keep trading this, captured it again this morning. Again, they both stopped right at the ATR high of the day. I mean, it's going to come down to what the reaction is to the Fed and where the market is at the end of the day. But those are the two names at the top of the whiteboard. Precious metals grinding higher on gold. Silver still hasn't broken out of that pennant. So, this is entry point here. There's an entry point up here. It's making new highs in here. I mean, on this particular move, not new highs, but it makes higher lows and higher highs. But silver doesn't get started until it breaks out of that base. You need spot physical silver in the 10 3/4 area to really get excited. I mean, you can get excited now if you want, but for me, I'm not breaking out the party hats till we take out that 10 3/4, even $11 range. Roblox and Doximity, recent acquisitions, Trade Desk, all of which are trying to move higher. ARM, Illumina, and GEHC, that looks real good today. All right, come out. I mean, none of this matters until we see a reaction to the news here. I've scaled back the Tesla in any portfolio where I thought I just needed a little bit more cash, but closes above 240, I'll own that. I better go get my cold brew coffee so I'm ready for this action. I'll be right back. Got 10 minutes. Saddle up, everybody. Smoke them if you got them. And take your seats. Circus starts 10 minutes. Nothing like a fresh, sweet blueberry, am I right? Does anybody else cold brew their coffee? It's delicious. I think it's the only way to have coffee. We got this little cold brew coffee machine. So it cold brews a lot faster. You don't have to like remember and like put it in the fridge overnight. All right, taking bets. What do you guys got for me? How many basis points? $25 from Steven. Agreed. Nina 25. 30. Very funny. 31 for Brian OG. Mm-hmm. Now, mind you, for those of you joining us right now, don't trade with us every day. I don't trade the number. The knee-jerk reaction is not what I care about. And in all honesty, I kind of hope the knee-jerk is down. I'm going to go out on a limb and say if it is 75 basis points, that's not going to be received well. Gold's flat. Silver's down over 1%. Treasury's down over 0.5%. S&P's flat. Equally weighted S&P's flat. Nasdaq's flat. Dow's flat. Everything's flat right now, waiting for the pop. Treasuries are selling off. I always wonder if someone has the news before it drops, but today it seems like it's just flat right up to the news pop. Huge down, huge up, big tails in both directions. Huge, huge up. Massive up bar. I believe it when I see it. Let's see where the bar ends. This is just a couple of seconds in here. I don't believe it until I see it stop. Well, there it is. Wow. That is an aggressive move higher. Okay, 50 basis points. That's a move higher, ladies and gentlemen. Let's see where we are at 230. Now all that Powell can do is screw it up from here. I won't believe this till it's over, till the bar is over here. No movement. First of all, here's the beauty of our situation. There's nothing for us to do. We're fully invested. Anything we do extra right now is just for fun. It's not, it's just icing on the cake. So trying to maintain my, contain my enthusiasm, because we're already enjoying all of this pop. You know what I'm saying? There's just no way I'm doing anything right here. And of course, for us, we don't need to do anything because we are max long. I mean, the risk monitor went green last week, but I hate when the knee-jerk reaction is a skyrocket. That always makes me feel a little bit nauseous. That always makes me a little bit nauseous, but let's hope it can continue. I mean, if the market continues, this was a massive 3-minute bar. If it's able to stay above the low of that bar, by the end of the day, I'll be impressed. you know, and Powell's going to have to do some talking. So absolutely no decisions right now for me. I'm not adding anything. Why would we? We're fully invested. So this is just an enjoyment. When it comes to the carry trade, so the part of my portfolio I day trade, I don't start day trading on that pop. If this is a classic Fed day armor carry trade, what's going to happen is the pop, the flag, so you get the flag pole, the flag that gets built over the next half hour, he starts speaking, doesn't say anything to upset the apple cart, and we break out of that wedge, that wedge pattern, bang, and you get on a carry trade for the rest of the day. But, you know, I don't like big up bars when the news drops. They make me nervous. So just patience in here as we watch. These are all the big indexes. These are the indexes that make up the ARMR risk monitor. I said the S&P weighted, Qs weighted, small caps, and treasuries. Then we go over here and we see the Dow, the equally weighted S&P that just had an enormous up bar there, as they all did, and the equally weighted NASDAQ 100. Then we would look at things like the value index, the momentum, so there's the value index pop right there. This is the momentum index. You know, there's the pop and the momentum index. So you're looking at a 3-minute bar chart inset and the daily chart out here. So you need to see momentum take out these highs to join the rest of the market. You know, the saving grace of the market, even when it was selling off, was always high yield debt. And we talked about that. We said, gosh, look at high yield debt. It won't break that third Fibonacci trend line. It just keeps climbing up that trend line. Shook out below, immediately recaptured. So high yield debt, if you go back and look at it, high yield debt made a new high back here in July, shook out and made a new high again in early August, and it's just cruising. So, you know, it's very hard to be bearish the stock market when junk bonds are leading equities. I mean, they usually lead equities up and down. But I mean, they don't have to lead on the upside. They could just kind of go sideways as long as junk bonds aren't breaking down and yields going up. Everything's okay in the world, right? In theory, this is just a theory. The junk bonds are the companies that have junk debt, that are most leveraged, that have the biggest difficulties. So if you're really going into a recession, then those are the companies that suffer the most, and junk bonds break down. People aren't willing to take that risk, and that often leads equity, right? So junk bonds are leading equity. They blew out to new highs a few weeks ago. So even in here, when we went to risk monitor red, and this obviously got wrecked for a couple of days. So it looked like, okay, junk bonds are breaking that third Fibonacci trend line. This is going to get ugly, and it immediately recaptured, and that was the saving grace. Now the Fed goes and cuts 50 basis points. Let's see something here. Let's see, what were the changes? Recent indicators suggest, this is the comment, suggest the economic activity continued to expand at a solid pace. Job gains have slowed. Before they said moderated. Now they said job gains has slowed. And the unemployment rate has moved up but remains low. Inflation has made further progress towards the committee's 2% objective but remains somewhat elevated. Before they said inflation has eased over the past year but remains somewhat elevated. In recent months, there has been some. So these comments are all more bullish and explain why they cut 50 basis points. Committee seeks to achieve. Okay. Committee has gained greater confidence that inflation is moving steadily towards 2%. Now roughly in balance. In light of the progress on inflation and the balance of risk, committee lowered the target rate to 5. Target rate by 0.5% to 4 3/4. In considering additional adjustments to the target range for the Fed Fund, the committee will carefully assess the data, blah, blah, blah. Committee does not expect to be, it will be appropriate to reduce. Oh, so they took that out. Before they said the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving towards. So they took all of that out. In other words, they're getting much more comfortable that inflation is coming down and they can keep dropping rates. The committee is committed to supporting maximum employment, blah, blah, blah. So there was only one dissent, and that was Michelle Bowman, who only wanted to do 1/4 basis points. That's about as bullish as you're going to get, guys. So if the market can't break out in here, we got a problem. Because that's as bullish as we're going to get. 75 would have been, I think, scary to the market. It would have been too much. What are your thoughts? You guys got for me? Anything? Nugget is up 4%. So let's go look at gold and silver, how they respond to that. These are daily charts, not intraday. So, if this continues, gold stocks breaking out to new highs, gold hits a new high, silver yet to go to a new high. How does Bitcoin react to this? Bitcoin is actually coming off a little bit. Popped and then reversed. So look, the reverse is happening right now as expected. I just hate that initial pop. I really do. So everybody just step away from the keys. Got to see where we are. This is what I'm expecting. You get the initial surge, then you come down to test. It needs to hold in here. And then when he starts speaking, start to come out. And then we got a day trade we might try. And the market's almost flat again. So it's giving it all away. Just what I didn't want to see. Now Powell's going to have to do some serious tap dancing. I'm with you on that, Brian. Sell after giving up the ghost already. New lows there. This is where the day trade will come from. We're trading between ATRs now. When that pop happened, it pulled the ATR up right to here. This white line right here is the highs of the year. So it tried to break out to new highs, pull back to it. This would be the area to look to get long the market. Now we're looking at the 3-minute and the 1-minute. It's a reversal bar right here. You can use the low right in here as the stop. You could start building a position in the market if you wanted. That's for a carry trade. Normally I wouldn't do that till after he starts speaking, but that's just a perfect location. So I might get a little bit there. Don't wait for me to write this into the room. I'm going to be talking you through how I'm trading. You guys do whatever you want there. This isn't like a normal carry day. It's 562.88. So call it 562.78 would be the stop. I don't think, position sizing is key on days like today. How much risk do you want to put on if you want to do it? So I might have some on right in here. And then after he's speaking, if it breaks out of another pattern, like this is buying weakness. What I really want to do is buy it when it hits this high up here and takes out the ATR high of the day. And that after he's speaking, and that's when it's screaming. Treasuries are starting to move up. Ooh, nuggets up 6%. Precious metals are running. GDX is running. We're up 6% plus on nugget now. And you would be on a carry trade. Remember how we said we're going to be trading a little bit quicker? And I credit Chicago Dave with these entry points of a little bit quicker. So right in there is where I would take a position to start the carry trade. And maybe that's all I take. I don't know. It depends on how it trades in here. If it just skyrockets, I might have enough of a trade on. I don't know how much I want to risk today. I'm so long everywhere else as it is. Treasuries, Silver Fox says treasuries, the dollar and gold. Treasuries, the dollar and gold. I mean, right now treasury bonds are up, Pop. So they've started to come on. They're about to take out the highs of the initial reaction. The dollar, I mean, they're down on the day, treasury bonds, but they're about to hit a new high on the day. Let's go look at the dollar. Yeah, the dollar should break down on that, right? And there's the concern. This was the yen carry unwind. I don't think anyone's caught now. I think everyone knows what was coming here. So I don't know. That's just bullish to me on gold and silver. Here's physical gold making new highs. And here comes silver. You know, I don't know if this is the right pattern or that. Probably that. It's got to break out above the 1050 range for the party hats. Uber's running. Don't forget, we took an Uber position. There's a new high on treasuries since the news dropped. So treasuries are starting to come on. We took a position on Uber in front of the news. And it's of course, it popped on the news and it's moving up higher again, and then CORZ. So these were positions that we were day trading earlier in the day. And because we were up on them, we took them into the news, and so far so good there. And I might add those to the portfolio. Those would really be the last positions. I don't have any other room in the portfolio for anything else. And so there's just a couple positions around the edges I was looking to trade. Let's look at my two hateful eight names that I would own. I'm looking to own Tesla. I do own it. We own Tesla. I would own more of it. Okay, so I don't have a max position on. And then do I want any NVIDIA? This is the location right here before it goes like that and breaks the downtrend there. Gabe's asking about small caps. Okay, so first of all, let's be clear. ARMR Macro already owns triple the S&P or SSO and QLD. Okay, so last week the risk monitor went green. We put capital to work. Either I own triple the S&P, or in some portfolios, double the S&P, double the NASDAQ. But for all those portfolios, I do own twice the performance of the small cap index. So UWM. I'm not going triple the performance of the of small caps, but you certainly can. And when it comes down to which I own and why I own them, it has to do with what the rest of the portfolio looks like. So if I'm just following the macro fund, and our macro fund is only swing trading the indexes using the algos, then that portfolio is going to be long SPXL and UWM, or it's going to be long QLD, SSO, and UWM. You see what I'm saying? I'm doing S&P, the NASDAQ 100, and the small cap index. So now, if I've got a portfolio that's full of special situation investments, which are individual stocks, many of which benefit from small caps going up, I don't need the small cap index. So it's a question of managing risk. Like, what are you trying to do with your portfolio? Only you could figure that out, Gabe. So I can't tell you how to put that money to work. Okay. All I could say is how I run my capital. I've got my swing trading capital. All I do is own indexes. And in that portfolio, triple the S&P and double small cap indexes for me. I take that information and I manage money for others. So for capital I manage for others, I own double the S&P, double the NASDAQ, double small caps. If the portfolio I'm running, when I have a communication with a client, they want me to do X, we talk about it, we say, okay, we're going to follow the macro fund. Then their portfolio, long gold, long silver, long mining stocks, long treasury bonds, long double the S&P, the NASDAQ 100, and the small cap. That's what their portfolio looks like. Now, if I go to other individuals I run money for and they want individual stock investments, we're going to pick from column A and column B, right? I run a family office, so I have different portfolios I manage, and then I take and build a portfolio for somebody, okay? So I've got ARMR Invest names, some of which are going to be in portfolios I manage. Those are individual stocks. And then we've got ARMR Special Situation names, which are growth stocks, and they're going to be in the portfolio. Maybe 25% of a portfolio, this is a ballpark, but 25% of a portfolio would be ARMR Invest names that are more conservative, pay dividends, those types of things. That's 25% of a portfolio, 5 names, 5% each. Then 5 growth stocks, 5% each. That's another 25% of the portfolio. Then I'm working with 50% of the portfolio left. Now I'm going to divide that. Precious metals are going to be in there, and some indexes are going to be in there. Do you see what I'm saying? So it really depends on how you want to run money. And if it gets confusing, you can always pick up the phone, call me, and we can discuss working at that level. I'm happy to manage money for others, and something I've been doing for over 30 years. So if that's the best way to execute, then I'm happy to chat with you about it. But if you're going to do it on your own, I like to say, be the smart money. I can't tell you how to do it. I don't know what your risk tolerance, your goals are. You're executing yourself. If it makes sense in your mind to have, triple small caps in there, I mean, have at it. Have at it. I spread out my risk a little bit differently than you may. Okay, here's the small cap index. Certainly looks good. We got risk on in that box. We're making money on our trade. Let's see if it breaks out. But for me, I'd like a little bit of everything. Uh-oh, CORZ just blew out. Uh-oh. See, if I got CORZ in a portfolio, I don't need small caps. You see what I'm saying? I mean, that's the essence of small cap. Ooh, do I have enough of that? Yeah, I got my average position. I'm not going to make that any bigger. That's a good position. All right, we got 4 minutes until, the main attraction. And this is setting up, for those of you who've been carry trading with me for a long time, this is setting up to be a great carry trade to the close today if we take out the ATR high of the day. He starts speaking, we take out the ATR high of the day on the upside, bang, I'm going to have my whole position on. He starts speaking and the thing breaks down. I'm going to take off what I already put on at much lower, not much lower, but lower prices. I'll take that off and, market will go down. And hey, let me tell you something else. And Brian brings up a good point. Brian's point was, God, I kind of wish we were living in times where it didn't matter so much what the Fed said at every meeting. Everything hangs on the balance every meeting. You're so right, Brian. And let me, if you'll allow me to say this, Brian, if you and I take a step back, you manage money. If we take a step back, at the end of the day, does what happened today really matter? It really doesn't when it comes to you and I investing. That ARMR Invest portfolio has had a huge year. It does not change except for Friday at 3:30. The stops are weekly stops. So we don't have to care about the shenanigans today. And I can tell you with a fair amount of certainty that 50% of the time, if the market's up big today, it'll be down by Friday. And if it's down big today, it'll be up by Friday. So there is the argument, unless you're day trading with me, there's the argument that you should avoid the activity today. Where are we at the close Friday? Finish off whatever positions you needed to finish off. You already started last week. So if we're making new highs by the end of the week, you're done. Maybe you're done already, but I'm just saying you're done. And if we're taking out the lows and hitting stops, we raise cash, and that's it. And you could forget about this craziness. I totally agree. I mean, if you're not day trading, the insanity that's going on today is just total waste of time. And it should not affect your investments at all. Risk monitor went green last week. That affects our investments. We put money to work when the risk monitor goes green. Shenanigans on a Wednesday based on, Chairman Powell, who's about to speak. So I better go hit the button here to listen to this ridiculousness. You know what I'm saying, though, guys? Here, I'm going to put this up here so you can hear it when he starts speaking. I mean, right now, IWM is putting in the signal right now. If it closes up here to get long right now for a rip to the end of the day. I'm going to wait until he's done speaking, though. Let's hear what he has to say. You don't look now, but Pac Bio is above $2 again. Small cap stock that'll work is Pac Bio.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Order filled.
Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate.
Order
In light of the
filled.
progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do. And we concluded that this was the right thing for the economy, for the people that we serve. And that's how we made our decision. So that's one question. What was the second and
How
third?
do we make this, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking today, but the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber, Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening in the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that. And that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2% and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Okay, if you're on a carry trade, I mean, it went up right to the ATR and reversed. So no adding to it. Maybe you want to reduce it and see if this thing can break above the ATR. If it can't, there's no up trade right here.
Clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So now I would add though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, you know, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, you know, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smiley with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
All right, Nick.
Nick Timmeros, the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move.
Ooh, that's bullish.
Question was,
Well, is this about what happened in the employment data between this meeting and the last meeting? Or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
so I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on John, in 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby. Thank you, Colby Smith with the Financial Times. I'm just following up on Gina's question on rising unemployment. Is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims, we're not seeing rising layoffs, we're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and then that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael
McKee with Bloomberg TV and radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
We're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
What do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payroll the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it. so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chip. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates.
Order filled.
It looked like the neutral rate might even be negative. So
Order
people were
filled.
issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going.
I have no carry trades on now. See, I had some on here. I added a little more here. I ended up getting out around break even. Now it's coming back in. I've got nothing to do right now. It has to break out of this pattern on the upside for me to put a trade on today.
How high is it? I just don't think we know. Again, we only know how this works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. We'll do that by returning rates from their high level, which has really been
Long bonds are leaking here.
Which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense in the U.S. economy basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look. At this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulte with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had the highest.
I'm watching how the market trades down here near the lows of yesterday. That's the key. The lows of yesterday, the lows the day before. So, I'm looking for. This would have been the right setup for a breakout to the upside. It didn't happen. It broke down. Now it's coming right into the support zone. And if it reverses in here, I might try to trade off of that level.
At the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be.
But so far, this is like kind of why when it was up big in the first 3 minutes, I just hate that. I hate up big in the first 3 minutes. This is the reason why I hate that.
Really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's.
But at the end of the day, if you look at the market, it's just flat. It was flat before the news. It's still flat.
We don't tell people.
So no one's sniffing out anything, in my personal opinion.
Prices as opposed to inflation, and we understand that's painful.
Hi, Chair Powell, Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, there's a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection,
I'm moving too fast to help you guys out right now. I put a position on again, and I got break even as the stop because it just blew out when I put it on. So there's no point in me putting this into the room as I'm on a carry trade. I could be off of it in a second, but I'm on a carry trade. What can I say? I just can't put the order in and type as fast as the day is moving.
Based on the QCEW adjustment, which you referred to, there isn't a bright line. It will be. The unemployment rate is very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting. We'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance.
What I was looking at was this consolidation. I was trying to kind of talk you through that, saying here we are at the previous lows. This is the consolidation on those lows. And so once again, it's trying to move higher. So when it took out that spot, I think it was right in here. I was firing away. And then the stop has to move up to here or even break even at this point.
Sitting U.S. president should have a say in Fed decisions on interest rates, because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
I've already booked some of the gains on that initial pop, and I've got break even as my stop. So I'm not going to lose money on this little wiggle. And if we can break the downtrend, then we might have something. Other than that, we don't have anything but a lot of chop.
Last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to Basel III Endgame. I'm wondering if you are in alignment with him on those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question. Let me give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is that's happening with my support. That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. That we don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks for inflation, we had a historically tight labor market, There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. We now have a cooler labor market in part because of our activity. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision. And I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn.
Gosh, could you stop speaking so we can get to the trade?
Okay.
It's like a lot of whipsawing while he's speaking, and then we see what the real move is when he stops talking.
It's still at very solid levels. So I don't really see that. No. Thank you.
God, thank you. We're done. Can we stop talking? Now the move matters. This is what's going to matter right here. Do we break out of this little pennant to the upside and we have a run to the close, or do we take out this pivot low right here to the downside and the run to the close is the other way? I'll have a carry trade on if it breaks out. I'll have no carry trade on if it comes back in. And it looks like it's coming back in. All right. So, no harm, no foul right now when it comes to trading. You depending on how fast you are at this. I don't have any position on now. So again, I booked a little bit right near the high when it popped up, and then I raised the rest of my stop right to here. So I ended up making a small amount of money there. And so net, I have a tiny gain on trading today, but that's only because I've been trading so fast. It would be hard for you guys to mirror that today. When it comes to the discussion of whether or not the market is sniffing something out, in all due respect, I don't think it's sniffing anything right now. This is just option shenanigan. Expectations going into a number, things getting taken off. We won't really know what the market is sniffing until Friday at the close. Very often, the day of the Fed news gets reversed by Friday. So if the reaction today is selling, I expect it to be higher by Friday. If it was up big today, that would make me really, really uncomfortable. I would expect it to sell off tomorrow and Friday. That's just typically what happens. I mean, I don't know what's going to go on here. I'm just telling you how I feel about it. So I would hesitate before I make any decisions based on what the market is doing on a Fed day where really the Fed hit the mark, right? It did what it was asking it to do. The market wanted 50 basis points. That was the odds on bet. They did 50 basis points. This is really just clearing the options flow, in my opinion. I don't think there's anything else going on. Treasuries are getting whacked. Markets, equities are kind of flat. Silver is all over the place. Now it's down 2%. There's just not much to see here. There'll be a lot to see tomorrow and then Friday. It's 3:22. I don't expect to change my portfolio at all today. I'm hunting one more carry trade into the close, maybe, but I don't know. They might just sell it down right to the close. But each time we get to this location down here, there's a real bid that comes in. We got a lot of tails down in here. So I don't think I'm messing with this, though, unless we break the downtrend. If it comes back above this area in here, I'll probably put on a trade one more time. But truth be told, what's made me slightly positive today is that I've been buying the tails when it gets whacked into the space using this 1 minute chart. It gets whacked into the space, comes back above the red line. I get long. So when it pops, I can sell some, raise my stop, get out. It comes down. It's testing again. If it comes back above the consolidation in here, I should probably be firing away. But when I look at the portfolio of positions and the market itself, it's a flat day. It's just the market literally is flat. I mean, we're up a tenth of a percent on the S&P. I almost want to buy that right there. I think this is about to pop now because it goes back above where I just exited. I'm going to make myself wait for it to get into this zone right in here. And I'm not even sure I'm going to trade it. I don't know. I don't know if it's worth it right now. This is not a classic carry trade day when it comes to trading Fed day. You know what I'm saying? Like what we really wanted was to see this run up, pull back. We bought that, goes up to the ATR, takes out the ATR, and it's gone. It hasn't done that. So there's like a lot of chop in here. And do I want to put a trade on in the last half hour? Normally, I would never do that. Fed day, there's a whole bunch that could happen in a half an hour. This thing could blow out the highs. So I don't know. I don't know what I'm going to do here right now. Pay no attention to the metals. They go up on Fed news. They come down at the end of the day. It doesn't change our overall investment strategy. So forget it. Just forget it. Here comes a trade. Do I want to? I've been fighting it all day and eking out a profit. I guess we'll keep at it. Maybe the position size will be a little bit less. This is it. This is the move. You could be long again right there. See that? I mean, there's the opportunity one more time. And who knows what it's going to do between now and the end of the day. It's tricky, but that's going to be the area. $0.76. I think would have to be your stop. I don't think you can wait for it to come all the way back down in here. Remember how we use the black and the green lines. Once it gets going, the black and green lines are our stop. So I'm walking you through this trade again. I don't have time to type. I got the trade on right here. Comes back below there. I'm out. I might cut it down faster if it starts to reverse since it's coming right up into overhead. Okay, I'm going to raise some of the stop to the low of this bar right in here. In fact, I might bank some of it out just to make sure I get something out of the profit like I did the last time. So I just took a little bit out. Okay, so put on the full position again. I didn't go small. I went big as last time. And I just get a chance to flip some out as it runs up into this overhead here, just to make sure I'm making some money, and the stop will pretty much stay there. And we'll see if it goes. Kind of when I flip some out like that, it just gives me a cushion. If it comes back down, I'm taking it out of break even, and I made a little bit of money. Let me just be clear. No additions to the portfolio today. Let me see. Uber might be an addition. I'm already out of the trade. See, I already booked a tiny gain, and then it went back to break even, so I got out with a tiny gain. All right. So I can't write these in. I'm waiting for that bar that just skyrockets. It's not doing that right now, so I'm out. What time is it? It's 3:29. What's this bar? 3:30 bar. 3:30 bar. You're on your own from here to the close, guys. You know, I might be on a trade. I might not. I don't want to stop you from doing it. I'm just watching how it's behaving right here. Let's take a look at Uber. Am I going to hold this? I am going to hold it if it closes in the green box. I'm going to own Uber. I am. Oh, geez. Am I going to hold this? Depends on where that closes. If it's a big tail, I'm not going to hold it. If it closes higher, I might hold it. You know, if you're on a trade again, your stop's got to be up in here now. So really, the stop should be the black and the green bars where the stop should be. Just to be clear on that, I just didn't like I didn't like these tails in here. So, but I don't think I'll be long unless it goes above 36.32. So I'm not painting this right in here because I'm just not doing it yet. If it takes out that bar, I might do it. Comes in for a couple of bars, big yellow bar, couple of bars to hold, takes out that level. I might be on a trade. All right, I'm putting up on the board here what my end of day update is. You know, but it's subject. Okay, see, we're not long right here, and it's coming back in, so nothing to do right here. All right, so look, I may hold this overnight, and I might be on Uber, but you know, subject to change at 359. I mean, if the market's imploding, I'm not adding anything. The market holds up in this range on those positions we bought earlier, and we have gains in. I'm going to carry them overnight. Let's go over the portfolio. Want to see what we're dealing with here? Got ARM up a couple percent on the day. Doximity looks pretty good. GEHC is breaking out at the moment. Ooh, Illumina was having a decent run. See if it gets going. Nugget's still up on the day with silver down 2%. Pretty much giving it all away, though. It's just like the market itself. Trade desk, that's a new high. So those are the ARMR special situation names. And then here's our invest portfolio. Is anything near a stop? I mean, the answer is just no. There's just nothing near a stop. It's a big nothing day so far, but a excuse to whack silver back down and close the gap, and that's what's going on. Gold closed the gap, silver closed the gap. Typical. Don't mean a thing. No, it looks like I'm not going to stay with those trades. So I'll make some money
Order filled.
on those day trades for now, and we'll come back at them. I think I'll come back at them tomorrow.
Order filled.
All right, so I'm changing the end of day update. I'm looking to add those two names tomorrow. I'm going to book the gains I had on them today. So no new positions. need to press it. Happy to have what I've got in the portfolio, and I'll keep trading tomorrow. All right, 10 minutes to the close. Any last comments or thoughts from anybody? Oh, can you believe it? CORZ is going up at the close. You son of a gun. Uh-oh.
Order filled.
Oh, I might have to have some overnight, but shh, that'll be on the down low. Don't share that with anybody. The fact is, don't forget the rules of the strategy. If we take out the lows of today and yesterday and the day before, they're all the same on the S&P, the swing strategy that gets long is out. Bought it this day, goes up for a couple of days, takes out, we'd have to remove it. So what I would do, it doesn't change the risk monitor. That'll stay green. Sometimes the swing strategy gets shaken out and then it takes off. So the risk monitor stays green, but I would cut down my exposure to SPXL if that happens. I think the market's up tomorrow, but that's just my feeling. Selling on Fed day, rallies the next day. Rally on Fed day, sells off the next day. It just happens so frequently. It's crazy. But so, like I said, let's just say even Q and balanced, right? We've got our positions on, and at the end of the day, this is pretty much a non-entity day. That if the market closes here, it's down 0.2%. So it might be a lot of excitement and a lot of swinging, but nothing happened. The market's down 0.2%. It's not a big deal. Nothing. So it's what happens tomorrow and really Friday that'll matter. If things start leaking tomorrow, I'll cut back some of my index exposure. If it gets ugly by Friday, I don't know. We might be cutting back a lot of exposure. Conversely, market's strong by Friday. We have nothing we have to do because we're already invested. And, maybe we add a couple of our favorite names in here. I don't know, Uber or Core Solutions, I don't know, Tesla and Nvidia. That's like the barbell for me if I wanted. If I don't own QLD, if I own QLD in a portfolio, I don't need Tesla and Nvidia. But if I go the route of wanting to own, the two names in the hateful eight that I have an interest in, it's Nvidia and Tesla, the laggard and the leader. That's what I would do. So I'll be watching those tomorrow. I'll be watching. I really want to get on Uber. I kind of feel like I'm so torn, but that's a tail right now. And so there's no reason. I'll just pay up for it tomorrow. But that's just perfect setup. If it closes the week up here, it's just going to be ideal. Still watching CrowdStrike. I spoke about it this morning, not because I want to buy it right now. It has to close in this green box for me to get interested. Got to close back above the 50 and back above the exponential 200-day moving average. It closes up here, and then I have an interest. What I said this morning was this sell-off. My question to you is this a buying opportunity or the end of the line for CrowdStrike? I am in the camp of a buying opportunity if it hits the green box, because it reminds me, I talked about J&J this morning. But the better analogy is Intel. Intel, this is sometime in the late 80s, early 90s. Andy Grove was the CEO, and they came out with the next iteration of their chip, and there was like a flaw. Stock got wrecked, total panic. But at the end of the day, it didn't change the trajectory that Intel was the leading producer, of chips for the PC market that was in the process of an unbelievable boom. Fast forward to today, we have what was the leader in cybersecurity stumble with an upgrade. Somebody hit the wrong button and the upgrade went haywire, and it caused some high profile problems that were all over the newspaper. Does it change the trajectory of their growth strategy for a quarter or two because they have to make up for some of the mistakes? Maybe, but it's not like they were hacked. I mean, if they were hacked, forget it. I had no interest. But this is somebody lost their job because they did something stupid during an upgrade. All right, well, once that blows over, you just get like a once in a generation entry point into a stock that maybe you weren't on like me, and it ran away from me. We went from 200 to 400, and I stared at it. I can't believe I missed that. Well, here it is. Under 270 after getting whacked on something that's probably very short term. I know all the bad news. I mean, well, Elon Musk came out and said, I'm going to halt all my my upgrade, whatever it was. I mean, a couple guys came out with some comments, and I'm sure that's true. But at the end of the day, if you believe that this company has the state of the art when it comes to cybersecurity, they're going to pick the business back up and they'll keep on going. So, it's at the top of my whiteboard. I share with you a theory. The theory doesn't go into practice if it can't close in that green box. So if it breaks down in here, then my theory is incorrect. No harm, no foul. I don't own it. That's what the whiteboard's for. Put it on the whiteboard and see how it behaves. If it starts to come out and the ARMR algo gives a buy trigger, I'm going to be on that trade. All right, ladies and gentlemen, the last 2 minutes mean nothing. I look forward to seeing all of you again tomorrow, 8:45. We'll do our morning meeting. ARMR Report subscribers, I'll see you guys there at 8:45. ARMR Insiders will be there at 8:45. 9:30, we'll get our live stream going for ARMR Insiders. Everybody who joined us today, thanks for joining. Hope you enjoyed it. I look forward to working with you all again tomorrow. Everyone have a good night.